Are we witnessing a fresh warning sign for tech? Michael Burry's bearish bets on NVIDIA and Palantir are now sparking debate over whether the AI boom is heading for a correction. Joining us now is Philip Tortevsky from Wealth Within. Good to see you.
Good morning. Good to see you.
Talk to us about these comments from Michael Burry and what he means about NVIDIA and also Palantir.
Yeah, look, I think we've got to digest what Michael Burry does first and foremost. I mean, his name is so synonymous with market crashes, obviously the GFC.
Burying companies.
Well, yeah, I mean, if you want to put it that way. But, you know, because he's known for the GFC, oftentimes when he puts a bet on, people think automatically, hey, you know, the world's about to end tomorrow. But when you look at the style of Michael Burry, he is a contrarian by nature. So when I look at, you know, we've been studying charts for well over almost 20 years now. When you look at the price action of what has happened with NVIDIA and Palantir over the last year, vertical type price action.
Oh, it's been crazy.
Huge euphoria. And
$5 trillion valuation. I mean, come on.
Yeah, I know. And I mean, that doesn't end, right? And so being the contrarian Burry is, he's looking to play that aspect of the market. Recently, he bought Estee Lauder, a stock that had been down over 80 to 90%. So I think, you know, you take it with a grain of salt. He is trading the market and he's looking for opportunities at extremes. That's what I get from it.
It's interesting because the news overnight that SoftBank has decided to ditch its stake in NVIDIA. Do you think that's listening to Michael?
Yeah, I mean, look, Michael might also be playing into the fact that you've got, you know, even China now, you know, with, dare if I say this correctly, Huawei, the state-backed company, where they're getting into the chip game as well. So there is potentially this challenge to NVIDIA right now where, you know, there is a competitor coming up, potentially going to take some market share out of that space. So maybe he's playing into that idea. So could be.
I mean, look, there's a lot going on, right? You've got, every time I turn on YouTube, there's a different documentary about how AI is going to take your job. Then there's another documentary about how companies are letting go of staff, blaming AI, but they're not really using AI. Then you've got investors who have been flocking to the AI world, constant warnings that stocks are overblown. And then Bill Gates comes out and says, no, they're not overblown. And this is nothing like the tech bubble at the start of the century because everyone's going to be using AI. Is this a rush to general artificial intelligence that we're expecting in 2 years' time? And what is going on in the market?
Look, I think lofty valuations are not a new thing for the tech sector. And I mean, if we go back to the dot-com era, we also had this similar scenario play out. We had lofty valuations. We saw a correction during the dot-com bubble. But what eventuated was actually really nice for investors in that we found the diamonds in the rough. We found the companies that were able to use the technology.
Well, it's like a gold rush, right? Everyone picks up a shovel, promises investors, I've got the spot. Yep. We don't know whether or not they do until hindsight. Yeah,
and reality is about 80 to 90% of companies in the AI space now aren't profitable. And that was very similar to what happened in 2000 with the dot-com era. So we will see a flush out eventually at some point. The diamonds in the rough will survive, like the Amazons back then, albeit there will be corrections. But I mean, it's exciting for investors because when that time comes, tomorrow's leaders will be found.
Do you see that there could be a major correction though for all AI stocks as a result of that? I mean, you have a look at what happened during the tech war, if you want to call it, and as you say, the Apples of the world, they're still here. But the Time Warner AOLs of the world didn't really do very well. Do you see that the broader market will, I guess, tarnish all of the tech stocks, the AI companies this time around?
History tells us that's the case, yeah.
Right.
And it has always been that way. With the good companies, they will fall in light of the general correction. You know, even talking GFC, there was great Australian companies that, stocks like Fortescue that fell 80 to 90%, big banks, Australian banks that fell 50%. So good stocks aren't immune to a fall during market corrections and crashes, but hey, you know, therein lies the opportunity for good stock picking when they are at those undervalued levels.
From an Australian perspective though, a lot of Australian super funds are heavily weighted towards US tech. How do you think we'll be feeling about that if we're about to retire?
Yeah, not happy. Yeah, look, I mean, it is, and it's growing. It's a growing number. And I think the more concerning part for me is, yes, Australians are now moving into this hot space, and it's been happening over a number of years. It's, I guess, the risk on risk factor that we're seeing now with these ETFs and leveraged ETFs. You know, there are triple, double, some are seeing 5 times leveraged ETFs in this particular sector. So you're throwing risk on top of risk in a concentrated area. I mean, it's not great.
Yeah, I guess concerns about whether there are bubbles or not, I mean, we'll never really find out, will we? Let's talk about another topic now, because after months of trading between 9,000 and 9,300, analysts are now divided on whether the ASX is coiling for a breakout or bracing for a breakdown. It's how we all feel as we head towards the end of the year anyway. The ASX has been locked in a pretty tight range. What do you think it suggests?
Look, I think the index is in such an interesting spot right now, more than ever, because there's been a shift in dynamics in what we're seeing. I mean, as I mentioned earlier, we're looking at the price action of the index, and since 2009, the index has been in this really healthy uptrend. And healthy uptrends, just to put out there, they survive with healthy buyer and seller activity. No uptrend is sustainable with only buyer activity. That is, I guess, the epitome of when you start to see euphoria. And so the index now has broken out of the sustainable rate of rise over the last year or couple of months. We've seen only buying activity over the last 6-7 months. Now we're starting to see the selling. So this is where it gets interesting for me, because we're on an accelerated run up. If the selling is weak through November and we generally fall within the 7 to 8%, now we're starting to fall into that 05 period where we saw exorbitant buying, weak selling, and that generally lends itself to that euphoric type run up, which isn't sustainable. So we might be nearing a potential significant peak in the market. But if we do see a bit of a deeper correction, following what we're seeing right now, 15 to 20%, that'd be a lot healthier for sustained upward growth for the market long term.
It's interesting because we know that stock markets are not a reflection of the health of the economy, but they eventually do catch up when people aren't paying or can't afford, and companies start reporting pretty flat or negative sales growth. And that has started to happen. We look at the earnings reports over this year, it's been pretty flat. Yeah. Now we've got a situation where unemployment's going up, inflation is back up again. We're worried about stagflation. Interest rates are more likely to go up than down anytime soon. If I was an investor, I would be anticipating some bad news coming from a lot of companies.
Yeah, and I mean, look, it is potential. We've seen the banks, Westpac and Commonwealth Bank, obviously this week report Q3 and not great. The market didn't like it. But I mean, for me, to your point, right now it becomes a scenario as the market accelerates and climbs this wall of worry, as they say. Generally, at the end of market peaks, you'll see not great news coming out, but yet euphoric type buying. And when we see that combination happening, it then, for investors, it becomes a consideration. Hey, well, is the buy and hold approach the best approach at this moment in time, or do I need to be more active with my investing and monitoring the prices much closer? There
are a lot of armchair experts out there, and half the chances are people are watching this interview sitting on the toilet on their phone right now. As they do, they're investing, and there's a lot of armchair investors and experts, as I say. What do you think the indicators are that they should be looking for to see which direction the markets will go?
I think this pullback is crucial. I think monitor this pullback, see how far we go down. If we stay in the vicinity of 7 to 8%, seasonality speaking, we should see a bump up during Christmas time. But if it's a short pullback, real renewed strength buying, we take out the all-time high fast, and we keep that pace where we're just seeing bullishness month after month with not much selling, I think that is a time where, shifting the strategy towards thinking about, protecting positions would be, from my perspective, more wise than letting them hold and riding the dips, which could eventually be the big one.
Yeah, well, that's the one we've got to watch out for, but it will probably happen in America first, which is at least something. Give us a bit of an outlook for what you're expecting for 2026 when it comes to Australian equities.
Yeah, look, I think as long as we hold the November low shortly, I think a broad-based recovery will be on the table. We've seen the materials sector, we've seen the financial sector, we've seen the tech sector, they've all come off. And really, for our market to be sustainable on the way up, we're going to need materials and financials to be strong. So I think opportunity lies now broad sector. Energy is another one to really keep a nice focus on. That's had a decent pullback as well, showing signs, and I think that'd be, I guess, the dark horse, which is a bit more undervalued than the others. But look, I think broad economy, broad sectors, the opportunities are all there.
All right, Philip, really appreciate your time. Thank you so much.
Thanks.